All right. Good morning, good afternoon, good evening, everyone. This is Justin Paolini from Building a Trader. I know we're 5 minutes from the start time, so I'm just going to let everybody filter into the room, and then we'll start, hopefully right on time. Just remember the disclaimer, trading foreign exchange carries a high level of risk and may not be suitable for all investors. The high degree of leverage available can magnify your profits as well as your losses. You can lose more than your initial deposit. So before trading, please carefully consider the risks and the entering costs and seek independent advice as required. And contact us to discuss any questions or concerns you may have because we are here to help. And that's why we bring you industry legends and traders like Brent Donnelly. And we're quite honored to have him on the show today. So while we're waiting for him to join, let me just tell you how I met Brent Donnelly from a work perspective. I got to know him through his piece, AMFX. Now, he started writing this daily piece when he was back at Citigroup. And through the grapevine, some research pieces get passed from person to person. And eventually I stumbled across them many years ago. And many of my contacts were always asking for the AMFX piece. Did you get Donnelly today? Where's Donnelly, etc. So that's how I actually learned about Brent Donnelly and what he was doing back in the industry. So long story short, after many years, Brent has transitioned from inside a bank to Spectra FX, which is, I guess it has much less red tape, much less bureaucracy, and that way he's been able to disseminate a bit of his teachings. He's written a couple of books, and I guess that's why we've been fortunate enough to get him on today.
Hey guys, hey, I'm sorry about that. I was in a Google thing and you guys are in a Zoom thing, so sorry for wasting everyone's 10 minutes.
Yeah, that's not a problem. It was my fault because we just got lost in translation there. Plus, I sent you the link that's under the name of my fiance, so everybody sees Ilaria Trivedi, but that is Brent Donnelly, believe it or not. All right. So let me just go through this really quickly, Brent.
Sure.
And sorry, everybody. Thank you for waiting. Today, we're going to be talking about how to be an alpha trader, just like Brent Donnelly. Before you logged on, Brent, I just told them how I got to know about you with the AMFX piece, and you were in Citigroup at that point, and through contacts, your piece just trickled down the grapevine, and so that's how. As soon as I saw your books, I was like, "Wow, this guy is out of the bank." And so, without the red tape, maybe
I escaped.
You escaped.
Yeah.
So here's why you should listen to Brent Donnelly. He's been trading since the 90s. He has seen all of the major crashes and events in the markets since then that you will read about in Jack Schwager's books, and that you will read in any other huge trading book since then. He survived through it all, and he's here to tell you, how to do so yourself. I'm biased, of course. I already wrote why you should have Alpha Trader on your bookshelf, on your reading list. If you haven't bought it yet, get a copy because it's really worth it. And people that have been with me for a while know that I don't say this about every trading book out there. I actually don't say it about any trading book out there. But I like the fact that Brent approached his book talking about risk first and what can go wrong if you're not careful in the markets. And then he opened up into tactics and strategies and how to go about setting up your stall. And I like that approach because so many people are focused on the upside and they don't talk about the downside, or they just talk about theories and whatnot. But we're not academics; we're traders, and we have a different approach. So how to get Brent's insights nowadays? He's still writing AMFX, and he's actually made it public. So if you go over to spectramarkets.com/am-fx, you can go and get his newsletter. And he's actually kind enough. He has a free email list as well, and he actually sends out bits and bobs now and again on his free email list as well. But I mean, the price is really low compared to the the insights that he does share. And talking about insights, this is from today's AMFX, and I love this sentence. It is better to try and fail than to forever wonder what kind of trader you could have been. I really like this because so many people, because they got burnt maybe once before perfecting their trading strategies, they never touched the markets again, or they just have a relationship with money that doesn't allow them to start in the first place. And fact is, once you get a bit of education, you got to dip your toes in, controlling your risk, of course, but you don't want to regret this and never not knowing what you could have done in the markets. So I really like this, Brent.
You mind if I interrupt for 2 seconds, Justin, before you keep going?
This is all about you. You have to interrupt.
All right, sure. So just to put a little bit of context around that, because one thing that I thought was really interesting in 2008 was, so I would have been like 30, around 30 years old then. And so I was kind of like in the middle of my career in terms of seniority. I was like, I wasn't a junior dealer, but I definitely wasn't a senior dealer. And so there was like around 10 of us trading on the FX desk at Lehman. I was at Lehman Brothers. And one really interesting thing was, so obviously the shit hit the fan in 2008 and volatility was like nothing that anyone had ever seen. And essentially there was two reactions to it. Like I would say 8 out of 10 people just went under the desk and basically played defense and tried not to get destroyed. And then 2 people, one of them was me and one was this other guy, kind of saw like, this is the time to make hay, right? Like whatever the cliche is you want to use when markets are flying around. And the reason I put that in my piece today is that when markets are flying around, that's the opportunity. So like what you'll see a lot, if you're in a group of like people that are kind of cynical, traders, you'll see people complaining that volatility is too low, it's too hard or whatever. There's nothing going on, especially in FX, because there's periods where nothing's going on. And then those same people will complain when things are flying around because it's too whippy and too choppy and all that. So the reality is, if you're a good trader, you want volatility, and so some amount of like courage is required to be a good trader. And so that courage is shown when things are flying around. And so that was in, I think, Justin, that was in my bit about trading fast markets, because I have a bit of my book about that, because it's really important to identify what regime you're in, and whether you're trading like systematic, technicals, fundamentals, whatever, knowing what kind of regime you're in is really important. And there's easy ways to determine that. It's not rocket science. Like just simply looking at VIX, I know like below 16 or so, I generally have trouble making money, or it's harder for me to make money. And like above 30, I find it's never easy, but like on the continuum, it's much easier to make money when VIX is above 30. And then in between is kind of like the normal when I'm grinding and having good times and bad times. However, that's just one example, but having learned that, I trade a lot differently when VIX is below 16 or so. I know like breakouts don't work very well when volatility is low, for example. Now I'm talking about equity vol, and I trade FX more than equities, but all the volatility is correlated, and you can look at other measures of FX vol. Generally, you get the same kind of answer. But anyways, I just wanted to mention that that's where that quote came from, because one thing I found surprising, so I've been a manager at a bunch of banks, and so sometimes I had like between 5 and like 15 traders reporting to me, and I'm a very risk-loving individual, and like that's my superpower and my kryptonite, is that I like taking risk. So because I think you only know what you see, and you kind of, I think, generally over extrapolate from your own experience into other people's experiences. I was surprised how risk averse a lot of traders were that have worked for me. In fact, more traders were risk averse than risk loving, I would say. And it's just like a completely different set of skills, or not really skills, but like a completely different set of steps to go from risk loving to like make sure you don't blow yourself up is one category. And then like risk averse and like you can never pull the trigger is a different category. And then, addressing that is completely different as a manager. So when I started managing, I was expecting to have to like have these rules-based systems to control people's risk. But what actually I had to do a lot more was force people to take risk because they were too risk averse.
I can actually empathize with that because with humility, because I never worked at the levels you worked at. But when I started right out of university, I went into a boutique broker up in Milan, and the guy next to me blew up after, I think it was just a few months. His entire account. He was also managing for external accounts, and he blew up right away. And the manager that I was working for also failed to deliver on his trading quotas. So I didn't really get off to a happy start with my experience. And that does affect, like you say, you extrapolate from your own experience, and that really affected me. And I've always been risk averse since. And to be honest, I think that's one thing that kept me alive in the markets, because I spent a long time on the retail side. I didn't spend much time on the, in the industry. I spent a lot of time on the retail side, and most retail traders come at this with the opposite approach. They seek risk, they want to trade, they want to get active, and people that transition from a day job to trading often bring the 9 to 5 kind of work ethic to trading. So it's like,
Right.
if I'm not active, then something's wrong. So my
Well, and
coach.
that speaks to another point, which I think is really important if you are a risk-loving person, which I am. So like I love gambling, sports gambling. I play a lot of poker and all that stuff. Is that it's very easy to confuse the two. So if you look in like, I don't know if everyone knows what the DSM-5 is, but it's the guidebook that psychologists use to diagnose mental illness. And so it has a lot of different sections, and one of the sections is on gambling addiction. And if you go through it, it's actually really interesting. I put it in one of my books. I can't remember which one, but it's really interesting how if you just change the word gambling to the word trading, you can see yourself. If you're someone who overtrades, you can really see it in there, and that, bad trading can look a lot like gambling. And I think generally that's one risk that you come in with in retail, especially if you have a small account, is that the money isn't big enough to like feel like it's going to move the needle. Like if you have $1 million in your account, okay, if I make 10%, that's $100,000. That's real money. But if you have like 10 grand in your account, then you're like, well, making $1,000 isn't really going to do much for me. So you tend to like take disproportionate amounts of risk percentage wise. And then, your risk of ruin just skyrockets because, even if you have a ton of edge, that's why people lose in the casinos generally. It's not really because of the edge that the casino has, which obviously helps them, but a lot of it is just that the zero bound, you run out of money before the bank or the casino does, right? So even if I gave someone 60-40 odds on a coin toss and they start with $10, there's a decent chance they're going to ruin themselves just simply because they run out of money. So anyways, my original point just being that it's really important to, if you're a risk-seeking person, to make sure that you understand what you're doing is to make money and not to entertain yourself or to gamble. Because I've caught myself doing it before. I've kind of learned a lot over the years about this because that's my weakness. But I've definitely literally been sitting there going like, man, I'm bored. I'm going to sell 50 euros just like because I'm bored. And doing it consciously is bad, but in a way that's almost better than doing it subconsciously, which I'm sure I was doing for many years. And I feel like, just to go on a bit of a tangent on that, one thing that really upped my trading, probably around the same time as that 2008 stuff at Lehman was around when I started doing this, was when I started kind of almost stepping outside of my own self and watching myself make mistakes. So like now, a lot of times like I'll react to a headline and I'll press the buttons, but I'll literally go like, there is no reason to be doing this. This is purely like monkey brain stuff. And then I'll just cover it at a 2-point loss and move on, and I won't care. Whereas like 10 years ago, I'd see a headline that's stupid and meaningless, hit a bid, and then I'd start going through all these mental gymnastics to justify why it's a good trade. Oh, well, I was thinking about going short anyway. And, it's trading heavy and I can just put my stop 15 points away. Those things can kill you, especially if you're short. Like I'm a little bit more short term. So like just junking 15 pips 3 times a day on random trades, that adds up to a lot of money. So one thing that was a big evolution for me was seeing my mistakes while I'm making them. Like I've literally been sitting on the desk and I've said to the guy next to me, like, dude, I'm bullish right now and I'm short. This makes no sense. And then that gives me the tools to then go like, okay, bullish and short, obviously stupid, let me cover. But I think when you're not as developed or when you're not honest with yourself, you can be short and then convince yourself why you're short instead of going in the other direction. So any way that you can kind of step outside yourself once in a while, and like a simple way to do that is just to get off the desk. I tried to have periods in the day. Part of this is because I do a lot of writing, but I tried to have periods in the day where either I just go off the desk and go outside or whatever, or I completely shut down my platform. Like I have like Reuters icon and Bloomberg and all that. And those are like flickering lights for a moth, right? Like especially if you trade correlations, you see little moves in gold and stocks and you want to jump in on something that's correlated. So what I tried to do is also close down my systems once in a while, because it also gives you just like a fresh take on the market, a fresh look. A lot of times you go to the bathroom and you're like, oh yeah, Aussie Kiwi. I thought about that this morning and then I forgot. Let me check if the setup's still there or whatever. So I feel like getting away from the screens so that you can be a kind of like an unbiased, this sounds a little weird maybe, but an unbiased observer of yourself, like thinking about what you're doing in an unbiased way and asking yourself like, okay, the last like button that I pushed when I sold, is that logical? Or am I just like in the zone and doing like random stuff because I'm bored?
That's a good point. I had a thought, now it's gone. So if it comes back, that means it was important. Otherwise, we'll just go forward.
Sure.
So going back to your book, you're a very prolific writer between your AMFX and your books. What is something from Alpha Trader that you think is extremely important, but most people ignore, especially on the retail side?
So my experience was like it's boring to go through my whole resume, but I started at a bank and then it was very transactional in the 90s. There wasn't much like prop trading or anything. It was just very flow oriented. So I didn't find it all that stimulating. So I quit and I went back to Canada where I'm from and traded my own money in the NASDAQ bubble. And then I came back to a bank and then I worked at a hedge fund after that. So I've kind of like seen the world from a few different angles. And one thing that just blows my mind, especially looking back, but even at the time, is how little people focus on or understand risk management. Like it's not that hard to have a robust risk management system where okay, I'm risking X amount of capital. I'm going to increase my risk as my capital goes up. Those are really basic concepts that like, honestly, I wasn't properly employing them. I was kind of doing it like, I would say, by osmosis or like kind of organically, you kind of absorb the concepts by watching and stuff. But I wasn't like systematically running a spreadsheet of like, okay, today, I have 100 grand in my account. I don't want to ever lose more than 3%. I'm just saying numbers, but whatever. I don't want to lose more than 3% of my account in any given day. So, I'm not going to lose more than 3 grand today. Even something as basic as that, many, many traders don't do. And that was actually part of the reason that I wrote The Art of Currency Trading was I feel like there's a lot of books that are like really bad. Scalping is fun, like books written by non-professionals to take advantage of the fact that there's a lot of money in retail trading education. But the products aren't credible necessarily. And then there's a lot of books of like international finance and covered interest arbitrage and like boring textbooks that have nothing to do with trading. And then there's a couple of good risk management books, and there's a lot of really good books on trade selection, right? Like tactics, strategy. I mean, the Market Wizards books are great for that. There's tons of books on technical analysis, trade ideas, but there aren't very many books on risk management. There's one really good one that I can recommend. But my opinion was like a good trading book should have all that stuff in it, right? It should have like trade selection and risk management. And so that was part of my motivation for writing Art of Currency Trading is, and one place where you really learn, the place you really need to understand risk management, that like where it really matters. And so you can sometimes get away with not having very good risk management. If you're in a fairly constant regime with a roughly constant amount of capital, you can kind of eyeball it and you'll probably be fine, right? Like in 2021, everything was pretty consistent. Like we were in a similar regime most of the time, a lot of call buying, a lot of like, it was a bull market. Volatility was kind of like not super low, but it was kind of medium for most of the year. And if you had roughly the same amount of capital in 2021, or the second half of 2020 even, you probably did okay. You're kind of guesstimating what your risk should be. But when volatility doubles or triples, or you get way more money in your account, or way less, that's when it really matters. So like a good trader will always have like a spreadsheet that has units, and you can have different ways of thinking about it, but the textbook way generally is like a few levels of conviction. Or my point was that people generally don't do a good enough job of setting up a systematic risk framework, and it's so easy to do, and yet it's not, I guess it's not sexy, right? So it's the book that I can recommend is like, it's kind of a bit boring, but it's super useful. And then you have the infrastructure, because one thing I found was, for example, I was talking about when your capital changes. So working at a hedge fund, they start you very small and then they boost your capital really fast. So like say you're going from running $50 million to running 400 over, that's possible. That could happen in like 6 months or 12 months. You have to know exactly what you're doing in terms of risk parameters. And the same thing happens if you open an account with 25 grand and you had a really good year and you have 110 grand in there. You shouldn't be trading the same position size at the start and at the end. But what I've seen is a lot of people do. And the other thing people do is they trade the same position size across instruments or when volatility changes. So like you shouldn't be trading the same number of E-minis if VIX is at 10, then when VIX is at 70, right? So adjusting risk for like dynamically for capital and for volatility, I think is something people don't do very well. Now, and I'm not just saying retail traders, even you can work at a bank and sit next to someone who's been trading for 7 years and they always trade 10 euros or they always trade 10 Aussie or 20 Aussie, 20 million Aussie or whatever. It's like a really lazy way of position sizing that people get stuck in, but it's wrong. Your position size should be dynamic based on, you don't have to constantly change it, but like you need to have a spreadsheet that gives you some sense of the volatility in your products and your capital, and then you triangulate from there what an appropriate position size would be based on, whatever your time frame and parameters are. So yeah, that's definitely the one that gets ignored, not only by retail, but also by wholesale institutional traders.
Yeah, on the retail side, it's, I guess the known knowns right now are what's come out of the turtles. So adjusting your position size based on volatility.
Yep.
That's become kind of standard on the retail side. And the other one is any book that's been written by Van Tharp or Tom Basso, because they've come out with some different books on position sizing. So there is a bit of information out there on the retail side. I guess it's just a matter of how you implement it. Because,
Yeah,
like you
and
say,
actually, an interesting thing is that in some ways, like I would guess your pod of people in some ways is more sophisticated than some institutional traders, because there isn't really like formal I mean, you get like formal trading about what all the asset classes are, and you sit on a few desks and stuff, but there isn't like a lot of formal risk management trading at banks. So it really comes down a lot to like who you work for or how diligent you are in terms of studying yourself. There's a lot of people that don't know what they're doing at banks. So I would guess that like from because you're like a diligent teacher who knows what he's doing, your pod might be on average just as good at risk management than people at a bank. And then hedge fund traders generally are much more like high level in terms of risk management because you have to be, because you have a risk manager sitting there. And a lot of times, like where I worked as the hedge fund I worked at, they honestly cared more about my volatility than they did about my returns, because they could leverage your returns for the investors. So what they didn't want was like people that were going to blow up. They didn't care as much about the returns, because when they were confident they knew what your returns were, then they could just leverage it.
Yeah, that's my experience with contacts. And the guy I worked with last year, he worked for Citadel, and now he's trading his own capital at home. And he said about this modulating your position size. He actually worked with a fixed fractional position size. And when I asked him about this, he said, "Well, we're not all Paul Tudor Jones here. You know, when you're trading size, increasing your size that much gets really tough." And so, having worked in what you said is exactly true. Coming from a hedge fund background, he's always been a prop trader his entire career,
Mm.
and so it's always been about the Sharpe ratio and
Right.
about the volatility of returns because it could be leveraged.
Mm.
And with a lot of retail traders these days seeking funding from prop shops, and let's not get into that right now, but retail traders have the issue of capitalization. So prop shops are a cheap way to try and leverage your system.
Yep.
Um, and that's why to the people that follow me, I always talk about Sharpe ratio and making sure that your returns are steady, because independently from the capital that they give you to trade, you'll always be there. You'll never get blasted by the markets, and you will gain capitalization. They will leverage you bit by
Yeah.
bit, but you'll always be in the game. So yeah.
And so what I would say too about that is that that doesn't mean you have to be like the boring steady Eddie that makes the same amount of money every single day. What it means, because I'm definitely not that. What it means is you got to think of yourself as a call option where wherever the money is coming from, whether it's your money or an investor or a bank or a hedge fund or whatever, is that you're not going to lose them a ton of money if you're wrong or you trade poorly. But the upside is you want to be as parabolic as or exponential as possible. And the way you do that is by like in a smart way, increasing your risk as you make money. So like there's some arbitrary cutoffs at banks and hedge funds, which is usually the new year. And people are like, well, it's arbitrary. Why do you slow down on Jan 1 when, that makes no sense. You should just be optimizing based on market opportunities. But the reality is that there's a metagame, which is that if you're down, like, okay, say I'm trying to make $10 million and I go from +7 to +5, not one person in wherever I work is going to say anything. But if on Jan 15 I go from 0 to -2, then I have a problem in terms of like possible shoulder taps and just like people getting anxious and saying, why don't you reduce your positions a little bit and all that kind of thing. And so you have to, even though maybe it's not like technically it's not optimal from like a market opportunities point of view, you have to understand what the metagame is that you're playing, and whatever your investors or whoever is supporting you, what those people, you have to manage those people, not just the market. So I think that's an area where people tend to fail a lot, is not understanding what the metagame is, and being way too linear with their risk. So they're taking the same risk all the time. And really what you should be doing is managing the downside, which usually often means a calendar break, but it doesn't always for retail. But managing the downside and then finding ways to have like unlimited upside. And you can do that like obviously through options and stuff, but you can also do it by identifying. So this is like the convergence of these are when I've had a huge year, there's always been a convergence of two things. One is like I have a decent base. Like, okay, say I'm trying to make $10, like $10 million, and I'm up like 4 in April or something like that. So like that's fine. That's a run rate of a buck a month, which would be 12 million. So, and then there's like a super opportunity, like some kind of central bank thing or something that I think is really huge. Then I'd be willing to put some much more than normal on it. Like say my normal trade size is like 3-5%. In that case, what you want to do is like go, okay, I'm going to put $1.5 million in, and I'm going to buy options on whatever this thing is. When basically the moment when you're strong P&L wise and you have a super strong view, I feel like taking some of that P&L and then putting it into a really strong view. And don't trick yourself into every view being super strong. I think if you're good, you generally know it when you see it. And then you say you put 1.5 on a bunch of options to express a specific view. Then sometimes you make 4 on that. Then you're up 8, and it's like the end of April or start of May. And so that's what my really good years have looked like. Has been always. So now there's all of this stuff is a spectrum. So it's the other side of that, or like the counter to that, is what's called the house money effect, which I'm sure many of you people know in here, but which is like a behavioral bias, which is, shows up in all the literature and in the research, which is if you win money, you treat that money differently than money you had previously. So if you take $1,000 to the casino and you win $3,000, that $3,000 that you won, you're more willing to just like make it rain with that money and spend it foolishly or gamble it foolishly. So you have to be aware of that. But what you want to do is when you're up and when you're strong and there's a strong opportunity, that's when you have a lot of courage and you say, okay, like I'm going to be a pig here. And that's like the Druckenmiller thing, which is like, there is a time to be a pig. And there's a cliche that goes the opposite way, but a lot of the Wall Street cliches are wrong. And so, but the time you don't do that is on, when you're weak and you've just lost money 6 days in a row. And then you see that like golden opportunity, like, sorry, but you don't have the strength to go all in at that moment. You just got to, do a normal bet size and hopefully you're right. And then, that gets you out of drawdown or whatever. But if you can bet big when you're doing really well, that's sometimes where you can really get the crazy outsized returns. But like I said, you don't just keep doubling down, because that's a horrible strategy. What I do in good years, in my best years, is like I form a base and then I make a couple of larger bets like that work out, and you get like a stair step up in your P&L. But then I don't just keep doubling down. Then usually like I'll just chill for a bit and maybe sort of like try to grind or scrape a little bit. And then essentially wait as long as possible. And then you're so strong that you feel like you don't have to be involved all the time, because you're strong in that at that point, and then you can just wait. And so it ends up being like a positive feedback loop where like the better I trade, the more selective I am and the more patient I am. And when I'm struggling, then I tend to be like scratching and looking for any opportunity to make my money back. And then that's like a negative feedback loop. So what you want to do ideally is like the concept from poker, tight aggressive, where you're essentially just like a good poker player folds a lot of hands and you want to be sitting there going, yeah, the setup looks fine, but like, I mean, my methodology is always like collecting all these data points all over the place and trying to put them together. So for me, like when there's like a super good trade, I honestly, I could list, I mean, I do it in my writing. I could list like 7 reasons why I'm bullish something. And like, I'll consider the alternative hypothesis and there's like 1 or 2 reasons to be bearish, but I can explain them away. That's like a really good trade. But then sometimes I'll have like 4 good reasons to do it, but then a couple two reasons, like positioning doesn't really suit and the entry point kind of sucks. And when I'm doing those trades, that's when I'm not trading well. So like the patience to wait for whatever your methodology is to give a lot of convergence. And so like I call it crosswinds, when you have like winds blowing all different directions like the dollar right now is like that, in my opinion, then you got to have the patience to just sit and do nothing. Or one technique that I use, because like I've said, I'm not very good at just doing nothing. It's like my urge is always to press the buttons, was I something that I discovered like about 10 years ago is there's something to be said for like understanding yourself and knowing what you can improve and what you can't. And I think like almost all characteristics of a human being you can work on and you can make them better. Willpower, I think, is one of the toughest ones. So for me, actually, a big step that I made in my trading was saying, like, my willpower sucks, and promising myself tomorrow that my willpower is going to be better is just like a recipe for frustration. Whereas creating friction between like behaviors that I don't want to do and those behaviors is a lot more powerful. Or finding ways to basically admit, okay, my willpower sucks, so what am I going to do about it? So one thing I started doing was essentially having like this, I think is easier with when you have a big amount of capital. But was I started running micro sized positions. So like if my normal position was like say 50 million euros, I would run like, okay, I don't have any high conviction, but I want to like keep my eye on the market and be involved. And like that's kind of like my thing. And I think there can, in theory, be some edge to being involved, although it's questionable. So what I would do is like run position of like 3 million or 5 million. So like literally 1/10 of my normal position. And then that kind of satisfied, like it scratched the itch of like, I need to have something to be really highly focused and paying attention. Because I found if I was flat, then I would just tend to drift and start doing research and stuff. Whereas like sometimes you wanted to stay in the zone, but you didn't really want to have a position because you didn't have a strong view. So then what I do in that case is, like I said, I just run like a micro position, which is essentially going to be meaningless for my P&L, but at least I have it and I'm looking at it and I'm kind of like doing the right things and acknowledging, okay, my willpower sucks, so I have to have something in it, but I want to have something small enough that it doesn't matter.
And even there, it goes back to discipline, because even if you risk, you could die from 1,000 paper cuts if you're not
That's
careful,
true.
even there.
That's true. So actually, that's a good point. So one thing that I learned when I went to work at the hedge fund, I had only traded really FX and rates at that point. So then I could trade at the hedge fund, I could trade futures, I could trade anything. So I was like, ooh, kid in a candy store, I'm gonna like start trading all this stuff. And one great benefit of that is you learn a lot. So like you learn about like how oil trades at the NYMEX close. And I think that makes me a better dollar Canada trader, for example, or whatever. But one mistake that I was making was I would run these tiny positions in like oil or gold or things I hadn't traded before as like a learning experience. But because the positions were so small, I didn't really risk manage them properly. So what ends up happening is like you hit your bullish target in gold, but you have like 10 contracts or something like that's not moving the needle. And you just go, screw it, I'll just wait and maybe it'll go another $50. Or like you hit your stop and you go, who cares? Like it's such a small position. But then like you said, it starts turning into paper cuts. So yeah, if you're going to run small positions for whatever reason, either to learn a new product or to like keep your head in the game or whatever, you still have to risk manage them like real positions. Otherwise, it will end up being a huge waste of money. Correct.
So there was just a question now from one of the people in the room, and she's asking, what question we're at here. So just to recap, Brent has actually covered a lot of ground here on risk management. So we talked about the Sharpe ratio, we talked about the size of the position and how to modulate that, and he also talked about something that gets ignored by retail traders, which is this whole discussion on risk management and regimes. So to take it back to the questions, so we don't get people lost.
Sure.
One other one is just going down the list here is what does it mean to lose well, and what is the best way that you cut your losses? Because trade, you said before, there aren't many good books out there on risk management, but I would fight that, saying there's even less on good trade management, which is something that not too many people talk about.
Yeah, that's a good point. So this depends a lot on time horizon, but I would say generally the thing that really helped me a lot was, and like I said, that acknowledging that my willpower isn't that great, is automating all my orders and all my OCOs. So as soon as I put a trade on, I put an OCO in. Like we always have a system that can do stops and take profits. And I put my orders in right away. And generally, I try to have like a fixed reassessment triggers. So like obviously the stop and the take profit are two, but then it might be like, okay, before F1, 24 hours before FOMC, or like an hour before FOMC, I'm going to reassess because that's a major event. Or like if it's a Canada position, I might say like if oil breaks 70, this I should reassess. But I try to have like fixed reassessment triggers and automate the position and then just sit there and leave it. And like, as much as you want to move your stop or change your parameters, or like you see it's almost at your take profit and you want to get out because you don't want to give back, generally anything that's not predetermined, I really, really try not to do it, because I feel like the emotional or the bias that you have when you're in the trade is so strong that you tend to do a lot of wrong things. Those flickering numbers are stimulating you at a physiological level and like making blood rush to your head and making you potentially nervous or making you grip your fists together and all that. And that's like suboptimal. What you want to do is have the plan laid out before, or like, it depends if you're doing event trading and fast market stuff, which I do a lot. What I'll do is like, I'll put the trade on just in reaction to whatever, like after FOMC, but then I have all these index cards. So as soon as I put the trade on, I always have an index card that matches whatever trade I'm doing. You can do it in Excel or whatever. I just find it's a little bit less abstract when it's like sitting on my desk as an index card. And then I have the parameters on there. And then when things settle down, I'll put them in the automated system. But having that as a setup and I don't trust myself to do the right thing when it gets there. So because I know what I'll end up doing is like going, maybe I'll let it run a bit. I saw another support on the chart. There's all kinds of nonsense that can go on in your head of like, oh, it looks bid, all that kind of stuff. So generally automating and like creating a set of rules for around every trade really helps me. The other thing too is that I think I've read this before somewhere else, I can't remember, but if you actually kind of treat losses as wins because you did the right thing, I think that's like a way that you can change your psychology. So when I like say I'm, like I have a position in something and it kind of goes against me before I've even automated my stop, it goes, say it's like a tight parameters trade where I'm only risking 25 pips or something, and I haven't even put my stop in yet, and it gets down to 25, like it's through my stop. I hit a bid, take the loss. That actually feels good to me because I'm doing the right thing. Whereas like, I think when I was 28 years old, I'd be like, I don't want to take the loss, don't want to take the loss. And then obviously then it's another 10 points lower. I don't want to, whereas, so like your mental attitude towards taking losses should be like, you absolutely love doing it, because that's how you succeed as a trader is just taking the loss when you know that it's the right thing to do. And like I said, trusting yourself, I think generally is a bad idea. What you want to do as much as you can is automate it.
So on this, I'm going to press you on this point just slightly.
Sure.
Since you say that automating the trade management because you don't trust yourself is the better way to go,
Yeah.
what do you think of technical ways of managing your trades? Because a lot of retail traders they either don't have the experience or the time to master the fundamental aspects of the market and
Yeah.
intermarket correlations and whatnot.
Mhm.
And I guess the fail-safe there is to just use technical tools to manage your trades, which arguably using technical analysis and tools to manage trades or to get out of trades might be actually better than using them to get into trades. But what is your view on
So
that?
yeah, so I have a strong view on this, but I'm like, I'm not the all-knowing God of trading. So like people do have different views on this, but I do have a very strong view on this, and it's backed up by a lot of empirical research and a lot of my own observations over 20 years, which is that generally technical analysis is good for risk management and it's not great for forecasting. So generally, like if you look at like Head and Shoulders, any basically almost any pattern, and there's entire books written about this, but then there's a lot of academic research too. They don't back test very well. So like Hindenburg Omen or Death Cross, whatever the thing is, generally they don't back test very well. And they're very regime sensitive mostly. So any breakout thing will work really well in a high vol environment, and range trading indicators will tend to work well in a like a low vol or mean reverting environment. But then the interesting thing is, so okay, techs don't back test very well, but then there's research that shows that PM, like portfolio managers that use technical analysis, outperform those that don't. And so like that sounds like a contradiction, but to me it's not, because the reason that PMs outperform if they use technical analysis is that it means generally that they're rigorous about their risk management, and they're not saying like, you know, I love this stock at 10, so when it's at 9 I want to buy more. They're saying I love this stock at 10, but if it goes to 850 I'm wrong. And so like technicals are really good for signaling that you're wrong on something. So like one hedge fund that I know some people at that, and it does, their returns are really good. What they do is they have a bunch of analysts and they have all their views, like, okay, we think dollar's going up and stocks down, whatever. But then they just filter everything with a moving average. So what that avoids is, okay, they're bearish stocks. They're not going to be short from the year 2010 like some funds have been short for 10 years because they think it's a bubble or whatever. They'll, if it's above the 50-day or whatever, 100-day or whatever they're using, then they get out, and then they'll try again when it goes back below. And like that's as simple as it gets, right? And even that's actually pretty effective. So the only thing I use, so generally I will use text as like trade entry and trade exit as like purely tactics. So I won't do a trade just because of a chart ever. Like I just, to me, it's just like, it's not my methodology. But I think part of it also comes down to your personality, and like you have to, your methodology has to fit your personality. So my personality is like, I love all kind of realms. I'm interested in science and astronomy and like math and puzzles, whatever. So I'm interested in a lot of things. And so to me, it's natural that I would then have an approach that kind of combines fundamentals, technicals, positioning, and everything. Whereas like someone who's super quanty might be more interested in just like having a more parameter driven, even if it's not systematic, more parameter driven approach. I think that's fine. The one place that I will use technicals, like, so what I'll do is something like, okay, I'm bullish, or right now I'm bearish dollar, but there's a whole bunch of reasons I don't want to be short yet. But if I saw, so like specific setups, I don't want to get into like too many specific setups, but like one good setup that in FX is just a really high volume capitulation. It works in futures as well. So like if you have like a 2 or 3 standard deviation volume on a 2 or 3 standard deviation move, like equities probably yesterday actually would fit that, but I don't know what volumes were yesterday. That can be a really good indicator. So like, is that technical? Yeah, but it's kind of like a multifaceted, it's a little bit more than just like drawing a line on a chart or whatever. I mean, I think there's something to be said. So in terms of just like more basic text, I think there is something to be said for just pure, like drawing horizontal lines on charts. And the reason is simply that, okay, like say I traded dollar yen at a bank for a long time. Sometimes we just get an order from like a huge corporate. I want to buy $2 billion yen over the next 3 days, no worse than 112. That's a realistic order that we would get. And so every time it gets around 112, we're just buying, and $2 billion is a lot. They might hold it for a few days. So if you're sitting at home and you're looking, you're like, huh, dollar yen seems to be bouncing off 112 a lot. And then as each subsequent bounce, obviously the information becomes more obvious, and then you can start playing the meta game of like, what if it breaks? Then everyone knows that 112 was a level and all that stuff. But there is a reason why horizontal lines work on charts. Whereas trend lines, I feel like I just don't believe in them as much, because I don't think there's like an underlying mechanism for why they should work. Whereas support and resistance, like it just makes sense. Sometimes you have huge orders, and I mean, I just said that dollar yen example, but there's like hundreds of examples like that I've seen, where it simply represents like the support and the resistance is simply telling you where the orders are. And the more it bounces off of there, then it creates like a little bit of a weird feedback loop where everyone knows that. So then the break is, all the bids are above and the stops are below. So then you got to start playing the meta game when the technicals are too obvious. So I guess like sort of summarizing, my approach is to use technicals mostly for risk management and tactics. My ideas tend to come a lot more from like studying the narrative, which is like kind of like fundamentals, but more like the second derivative of fundamentals, like not what's actually happening, but what people think is happening and how is that changing. That's usually where my ideas come from. And then that works in combination with positioning and sentiment because the narrative drives those things. And then I use a lot, as you know, Justin, a lot of cross-market stuff to see what other asset classes, what story are those telling, and why is the story in my asset class maybe not consistent with that. And then so like all those things would come first for me, and then technicals is more like, okay, now I'm bullish Aussie. Now how am I going to express it? Okay, we're in the middle of the range. This seems like a shitty entry point, but if I look at like basic support, resistance, places where there's been high volume, I love market profile. So I use that a lot because I find it's just very simple and yields very unambiguous results. And like, that's why I don't like Elliott wave and stuff, because I feel like whatever your bias going in tends to be, I've seen this so much with Elliott wave because I know a lot of people that use it. And if I know what their general view is, they start talking about Elliott wave, I know exactly what they're going to tell me, because if they were bullish generally if they were bullish the thing, they're going to show me why the setup's bullish. And if they were bearish before, they're going to show me why it's bearish. So I tend to lean towards simplicity because it's less likely to trigger confirmation bias, and just like the more complicated something is, the more likely you can just find the answer that you wanted in there. So I don't know, hopefully that helps. I know this is like such a big topic, but that's kind of my general view on it, is I use it for tactics. The one other thing too, I don't know, because I can't see the video for most people, but one word of caution for younger traders, especially if you're more quantitative, is that there's this elusive search for the holy grail, to find like that one system that works. And I'm telling you that like that does not exist. It's even if you find it, it won't work out of sample, or it'll work for a while and then it'll stop working. So like markets just aren't that simple. So, and also if you're trying to find that, you're competing against much more complicated dynamic, like, machine learning kind of systems that are way more dynamic. So even if you do find something that back tests really well, it doesn't mean to throw it away, because it can work out of sample for a long time. And you can make money creating systems and stuff. But I'm just saying, most of the people that I've seen do that, like literally started 15 years ago and they're still looking. So it's not the path generally to success. The path to success, whether you're quantitative or discretionary, is to find an edge that is a little bit, it doesn't have to be like insanely complicated, but that combines a couple of things. The same way that if you have two systems, like if you know the math of how trading systems works, if you have two systems with a low Sharpe and you combine them, that system will have a better Sharpe. If you have 50 of those and you combine them, then that you could end up with a system with an amazing Sharpe. But it's the combination of different approaches to me that generally yields success. And of the like super senior traders that I know that have like killed it for 25 years, I would say not one of those traders is purely a technical trader. Like not a single one of the very successful traders I've seen, through 20 years, is only using techs. You don't have to be like super jack of all trades to succeed though. Like some people just use techs and events. I mean, events is one area. There's a couple of them in the market with the new Market Wizards book that talk about that. But like events is an area where you can have a lot of edge and just be really good at that one thing. But just specifically text, it's, I think, a really hard game to play.
I think this is a good message for retail traders, and they need to hear it because most trading books are about technical setups and variations on the theme.
Excuse me.
And that's one reason why I thoroughly enjoyed your book, because you come at it from the different angle and you say, the ideas are generated by something completely different. It's from the fundamentals, from the narrative, which for everybody who's listening here, Brent does explain in depth in his book. So it's all out there. You can learn it, you can apply it, and then the execution is something different. But the idea generation comes from the fundamentals, the macro picture, and the narrative, and like you said, and the metagame.
And just to go back on one point there, so like I have a clear understanding of what my view is. Basically, it's like consolidating a ton of information and knowing what everyone else is doing, because I have a really big network that's developed over the years. So my edge is I know kind of what the market's thinking, and I know what the pain points are, and I know where it's going to go wrong or it's going to go right. But one really important thing is to understand what your edge is, because like that's a cliche, and I know it's a cliche, but it's true. A lot of people that are trading, even at banks and hedge funds, if you ask them and you get like this big, long, garbled response, that probably means that they need to hone in on what exactly their edge is. And it doesn't have to be some rocket science, super awesome, sophisticated thing. Like when I was day trading the NASDAQ bubble, my edge was I was faster at pushing the buttons, and I was willing to take a lot of risk, and I knew when to go all in on headlines, and that was it basically. So when I saw a headline, I knew if it was BS or if it was meaningful, and I traded it super aggressively, and I got out, and I barely ever had red on my screen, because if it didn't go my way right away, I just cut. And like that, I mean, there's a guy in the New Market Wizards that's his methodology too. That's perfectly legit. You don't have to have some like super macroeconomic point of view. That just happens to be like how I do my thing. But there's many, many ways of having an edge. You just have to make sure you kind of have an idea of, if you're new, it's fine. Like obviously you're trying to find that. But if you're not new, or even if you are new, you should be, out on the horizon, at least you should be able to see like, okay, I think that's what my edge is or is going to be, and I'm going to work towards that. And if you have no idea like what your edge is, then you need to take a break and kind of say, okay, like I need to figure out what the hell my edge is here, because there's so much money being deployed in trading by retail, actually a lot, but I was going to say by professionals, but also by retail, that like it's just ridiculously competitive. So if you don't have like a pretty much like you can write it on in one sentence edge, then you should try to focus on that. It's kind of similar to if you've ever like been involved in a startup or any company that's like trying to find its way. One thing they try to do is like create a vision statement or a mission statement that's usually one sentence long, and it's your North Star of like, okay, here's what I'm trying to do. And the same thing applies to trading. You should know like, okay, here's my edge and here's what I'm trying to do. And if you don't, then you just got to figure that out.
So just a couple of other things here before we let you go, because I know we've been on for an hour now. Two things are, before we get to a Q&A, talking about your edge. A lot of traders, including the best trader that I know that I worked with for a year, he would never divulge what he does. So talk about your edge and why you think having a book out there, and in this case, 2 books out there, will not erode your edge, and what your thoughts are on that.
Right. So that's a great question. The other thing people ask a lot, and that I'll just answer that too, is like, if you're such a good trader, why would you write a book about it? Like, because you're just telling everyone how to do it. To me, it's like writing a book about, like, if a professional golfer wrote a book about golf, like you're not going to be worried about like 500 people reading your book and then suddenly beating you on the PGA. Like it's so hard to become a good trader, and the pool of available opportunities is gigantic. So, and my edge is kind of nuanced anyways. So if you have like a specific, like if I was event trading in like single name stocks, where that trade less than 100,000 shares a day, and my edge was like, you know, understanding liquidity and the events around those, then like, of course I would not write a book about that because that would kill my edge. But when my edge is kind of nuanced and bigger picture, and I'm trading like the most liquid market in the world, FX, I just don't worry about it. It's not important. Like, it's just not an important consideration. And I love writing. So that's kind of like how, I always had a conflict between, I always had a conflict between being a writer or being a trader. And this is kind of how I've resolved that conflict, because I love doing both things. So I honestly, I don't remember if I answered the question now because I went off on a tangent.
Yeah, you got it.
Okay.
Yeah, thank you.
Yeah.
All right, so just before we let you go, if anyone has any questions for Brent, I think we'll take a few. We have a few minutes here. Write them in the chat box. And I'm not sure if you can see the chat box, Brent. If you can't, I'll relay them to you.
Yep, I do, and I allocated to 12:30, so I got lots of time. If it's up to you guys
Perfect. Okay.
and girls. Oh, sure. Yeah, I'll type it in the or actually let me just find if you just give me 2 seconds, I'll just grab I'll grab a link to it instead of typing it all out. And this was like the best risk I put in there. That's the best risk book that I read. And I actually took a bunch of the things directly out of that I've been using. I think I read that in 2006. And like my spreadsheets are still designed based on some stuff I took out of there, like how to, one thing that's really, that I didn't do before I read that book that I've been doing since, is keeping detailed records of my trades to look back and gain a greater understanding of things. Like I mentioned this, I think in Alpha Trader, sometimes I forget which book these things are in, but anyways, one thing I did, I thought like, I feel like I make money in the morning and I lose it in the afternoon, but I wasn't sure. So I started snapshotting my P&L every 30 minutes, and it revealed to me something which I thought I knew, but I wasn't sure. But when I saw it in terms of the actual magnitude, so essentially like if I normalized my P&L to like 7 a.m. equals 0, essentially I made 100% from 7 to 11, and then I lost about 35% from 11 to 5. So like that's meaningful dollars that I was, and the reason was that generally after 11, FX isn't too directional, and I was trading because I was bored instead of trading to make money was the takeaway. So basically what I started doing was trying as best as I could to square up at 11 or like cut my risk by 70%. And it helped a lot. So the takeaway really from the book was the more data that you accumulate about your trading, the more you can learn. But it's annoying, and it requires some discipline, because what ends up happening generally is, because I've tried to get people that work for me to do this, is they do it for like a month or 6 weeks or whatever, and then they get really busy for like a week, or they go away or something, and then they're like, oh, I fell too far behind, and then they just forget about it. And that's generally the pattern. So if you really want to actually embrace this, you need to actually do the work, and part of the work is gathering data on your own trading so you fully understand what the hell's going on under the hood. I can answer that. What are realistic returns for pro traders versus retail traders? So that's very hard to answer, but I'll try. Because like obviously it's really hard to generalize. The one thing about retail, so I've heard people say, you know, if I had more money, I would be able to trade better. Like, you know, people at hedge funds must have this huge advantage. That I can say unambiguously is completely backwards. It's way easier to trade as a retail investor or as a retail trader with less capital, because you don't have any constraint on capacity. So any trade idea you want to do, you can just do it. Whereas like at a hedge fund, even trading like ultras, which is like the super long bond futures, it was really hard for me to trade them because the liquidity wasn't good enough to turn the amount of like to make the trade worthwhile. Or even like even Aussie dollar, like as my capital started going up at Graham Capital, trading, like say I had 200 million Aussie and I'm long and then I decide I want to go short. It's almost impossible to turn it. You end up losing like 20 points when you're turning it. So the one thing I will say is that retail should have higher returns percentage wise, because you can literally trade anything and it's easier to have more leverage. It's really hard to say like what's a good return for retail because if you have an account that's like 10K, some people turn 10K into 100,000 in 1 year. And like, that's definitely possible. And it doesn't mean that person was gambling. But like, it's just not like a realistic target for me to set for someone because that's stupid. So I have to say on retail, it really just depends a lot on your methodology. But what you want to be doing is increasing when you're doing well and decreasing when you're doing poorly. But not doubling down, just increasing in a linear kind of way. So like if you had 10 grand in your account and then now you have 15, you should be taking 1.5 times as much risk as you were. But yeah, for me to give a returns number for retail, it's kind of Looney Tunes because it really depends on your initial capital. On the hedge fund side, it's like usually 6 to 20% is kind of the range. But again, it depends on vol. So like where I work, they tried to target like 6%, around a 6% vol. So even if you had 6% returns, that was a sharp of 1, which was okay. So that in terms of returns on the institutional side, it depends a lot on. So I think that kind of goes to the meta game and understanding what you're trying to do. And the number one thing, 6% in 1 year. To answer that question right there. So because what they can do is if like say you have $100 million of capital and you're making 6%, what they can do, maybe this is kind of in the weeds, but whatever, I started, so I'll just finish this thought, is they can have less than your capital on margin. So like if you're trading 100 million of capital, they might only have 10 million of margin against it. So if you make 6%, you've actually made 60% for them. That's why you have a tight stop loss because you're not fully margined. But anyway, so 6% sounds low, but the investors would be getting way more than that because of leverage. Okay, next question. How has trading risk events changed through career compared to today? Oh man, yeah, that's a great question. So when I was trading FX in like 2003, we would literally sit there and go, okay, like when payrolls comes out, which side will move the most? And you'd say, okay, I think the weak side's up. So if the number's strong, I think dollar yen's going to go up a lot. You just sit there with a bid about 50 points higher than the market. And as soon as the number came out, if it was strong, you just go bam, 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 bam. And there was always liquidity there. So now algorithms do that. So there's zero chance of getting a fill now on events, like on instantaneously on the events. So like I was saying, like that was kind of me taking my, like, I'm really fast on the keys from the day trading days to the institutional side when I went back to work at a bank. But that's not an edge anymore. Like being fast on the keys doesn't help when you're battling against algorithms. So the biggest change is that you don't get that initial move. So you have to have a really good understanding of what was priced in, what matters. So like, I feel like I'm pretty good at that. So like, I'll have an idea of, okay, I know the range of economist estimates. If it's a bit stronger than that, the algos are just going to take it and there's no trade. But like sometimes you'll have, okay, the market's really, let's just say, first of all, you have to know, like, does the market care about the event? And a lot of times the market doesn't. So it's just all noise. But like, let's say we could be entering a period where the market's going to be worried about the US economy because some of the data has been weak. So you say, okay, this, whatever, retail sales number is super important. You make that decision. Then you say, okay, the economist estimates go from -1% to +1%. Then, okay, 2 standard deviation misses -2.1%, and it comes out -4%. Then you go, okay, sure, the algos are going to sweep the first liquidity, but this is a massive miss on a number that the market cares about. So I'm going to go with, or on the contrary, if in the opposite situation, you go against it. So the way that it's changed, to answer your question, is that the first derivative or like the first step move is taken by the algos. So you have to be second derivative, and you have to like do the second trade, which is either like it hasn't moved enough and it's a go with, or fading it as a mean reversion trade, which tends to work more often, but does not work all the time either. So that's kind of, it's become a lot more nuanced and a lot more difficult to make money on events. It used to be pretty easy. You just, if the thing was bullish, you buy and you just sell really fast. And you can't really do that anymore. What system chart methodology do you use to track narratives, and whether they are becoming stale, overwritten by a different narrative? So I don't really use anything systematic other than positioning, but mostly positioning follows price. So that's one thing like you don't realize when you first start, is that basically the price just moves with the positioning, and the more something goes down, the more short the market gets, is generally true. But really what I'm doing is, reading a lot of research, talking to a lot of people, and recording that kind of just in my brain of like, okay, like, I have this bullish thesis, and when I talk to 10 people, everyone agrees with me, and we all have the same reasons, and the thing's already up 8% this month. Then I'm like, oh, that's a red flag, like everyone's thinking the same thing. You can follow it somewhat just simply with stuff like RSI. Like, what I use RSI a bit differently than people tend to use it. Like a lot of people use the, like, it went below 30, now it's back above, so I'm going to buy, or above 70, back below, so sell. That's the textbook way. The way I use it is just looking for like super mega extremes. Like the RSI has not been this low for 12 months or 24 months. And usually that can be like a sign that a narrative is going nuts. But really, I don't have a great answer for this, because really it's discretionary. I just read a lot and talk to a lot of people, and I start to see like, the QT narrative, like that's a really interesting one to me, because December, like the last 2 weeks of December, obviously people have been talking about the Fed for a while, but no one was talking about QT other than like one of the Fed governors mentioned it December 17th. But mostly the QT wasn't in the narrative in December. Then I get back January 4th, a couple of people mention it. January 6th, there's like news articles about it. JP Morgan's talking about it. Basically like 5 banks talked about it. And I'm like, holy shit, like QT is right in the narrative all of a sudden. And that was an important observation. Like I made it in my piece. I think I called it like QT2 with a vengeance, that like something coming onto the narrative that fast, price can't react instantaneously. So that's super important. So like that was a really important one. That's an example of how I would identify it, but it's simply just by like having your ear to the ground and reading a lot of stuff.
Any other questions, guys?
I do kind of go through that. I think in I don't remember what chapter, but in Alpha Trader, I do go through kind of like the evolution of narrative and how positioning and sentiment kind of move, sometimes battling each other, but tend to move a little bit generally in conjunction with the narrative, and then how it reaches extremes and then how it eventually bursts. Kind of like the way bubbles work, but on a more micro level, there's all these miniature little narrative bubbles going on. Or I mean, bubbles isn't the right word, but narrative ebbs and flows. Yeah.
They're from chapters 9 to 12 are my favorite chapters. So those are the ones to focus on.
Thanks.
All right, guys, if there aren't any other questions, then we'll let Brent go for today. Don't be shy. If you do have a question, he's here. Make good use of the time that he's offering us.
And I don't mind if anyone wants to email me. I'm always around. I can't promise I'll instantly reply, but if you send me an email at Spectra Markets, I'm happy to chat.
So I'll just scroll back up here in the meantime, because on that subject, on narrative and on idea generation, I guess the easiest way to follow it is to follow Brent's writing with the AMFX, because he puts everything in there. So if you want to get a feeling for it, or for the process, you take out a subscription for a while and understand what he's doing and how he's doing it.
And I see Mark threw a question in there. No. Many people trade. Like I don't really day trade as much. I mean, I do. It's for me, I kind of go from like 1 hour to 1 month would be a very long trade for me. But no, you can trade, you can day trade, or I don't know if you're asking like exclusively day trading, or can is that the only way to be successful? But you can have a mix of time horizons. You know, there are some people that just day trade, and that you can definitely succeed doing that, but you can also succeed having a variety of time frames. The one thing I will say is you have to understand what you're doing. So like bad traders will have a day trade and then go like, you know, I kind of like the stock anyways, you know, maybe I'll just keep it because it's underwater. So like going into a trade with an understanding, oh, I see what you're asking. Yeah, no, I mean, that is an important question, but that's more like an individual preference thing. You can definitely, there is a way to make money day trading, or there are many ways, but it doesn't suit everyone, and not everyone is cut out to do it. It's a specific style. So it's like, you know, saying like, can you succeed as a guitarist if you only like rock and roll? Like some people can, but some people are going to want to do classical guitar, and that's, you know, not everyone can do that. It's a style. Like day trading is a specific style, and it's high frequency, and it suits a specific personality, which is usually very risk loving. So I would say it's possible, but it's not for everyone.